as the markets go higher, and granted, this isn't for crypto, but there's a wealth effect that adds to inflation, right? So, I always tell people this is they say, well, why is, if the stock market goes up, does it potentially add to inflation? And the concept is that if you look at your 401k and it was 200,000 yesterday, and let's just say it's 400,000 today, and you were kind of thinking about a new car or a new TV, you're much more likely to say, yeah, let me go buy that new car, new TV, because look at my 401k. It's up massively. And so that's the reason why the Fed is more focused on the stock market and wanting it to come down. But right now they've lost that credibility.
The U.S. Central Bank made the decision to pause its tightening campaign during the recent Federal Open Market Committee meeting. However, they indicated plans for 2 additional rate increases later this year. Federal Reserve Chair Jay Powell is scheduled to testify before the House Financial Services Committee, and his semi-annual testimony will be closely monitored for insights into his stance on interest rates. The weakness in the U.S. market on Tuesday followed a week where the S&P 500 had experienced a technical bull market, defined as a 20% rally from its low point. This has sparked discussions about the sustainability of these gains, which have been largely driven by advancements in artificial intelligence-related stocks. Thomas Matthews, a senior markets economist at Capital Economics, believes that although there is growing enthusiasm about AI, it may not be sufficient to prevent a decline in the S&P 500 if the U.S. economy enters a recession later this year. Gareth Soloway shares his perspective on the stock market, highlighting the Federal Reserve's efforts to bring it down due to concerns about inflation. However, he also suggests that the Fed has lost credibility. Soloway discusses the digital asset Bitcoin, comparing it to gold, while drawing a parallel between silver and Ethereum. He also mentions the increasing credit card debt, potential interest rate hikes, and the unemployment rate.
From my perspective, is definitely Bitcoin's on that track to be that digital gold asset, and I think Ethereum is likely the silver kind of the crypto markets. And what's interesting about gold and silver, right? So gold is your pure play, where it's just a store of safety, inflation hedge, all that kind of stuff. And then Ethereum is like silver in that silver is more volatile than gold. So Bitcoin is less volatile and Ethereum is more volatile than Bitcoin. But also Ethereum has a use case, right? Bitcoin, there's, you don't really see a lot of stuff being built on top of that. So I think those, my guess is, and again, I could be wrong here, but my guess is the future is those two make up probably 80% plus of the overall market. And then you might have some of these other smaller coins kind of carving out their niches, but it's hard to know. I mean, and now we have the biggest news in the last week was that BlackRock filed for ETF, right? And so the question is, and I think the big question, we saw a little rally in crypto because of this, is does this mean because there's such a mega financial institution that they talked to Gary Gensler, and Gary Gensler might have said, hey, listen, yeah, Bitcoin isn't a security, so we're going to give you, the biggest financial institution, the green light. Because I think if you look at the stats, right, BlackRock's filed for like 75 ETFs. They've gotten approved on 74 of them, right? So they obviously have this kind of ability to kind of say, okay, if we're going to do this, the probabilities of success are very high. Yet we've seen the SEC reject time and time again a spot ETF. So it's kind of interesting here. What I do want to show here, and I'm going to flip over to my screen here, is I do want to go over that gold chart. A lot of people have been asking me, do you still see gold breaking out this year? We've kind of see gold languishing here. And the one thing I would just point to, and this brings us over to the stock market side of things, is that gold is stalling here. But what we're seeing is there's a massive inflow of bullishness into the market. So in general, when you see stocks like Nvidia going to new all-time highs and things, in general, you see gold falling more because it's a safety hedge, right? It's people saying, hey, I don't want to be in gold because I want to be in risk assets where I'm going to make more than a few percent on a yearly basis, which is more along the lines of what you expect from gold. And so I find it fascinating, and it's the same sort of thought process that I had when we were trading at the lows on gold in 2022 and going back to 2021, and the markets were at their highs. You weren't seeing, and by the way, this is when the Fed was raising most aggressively, and generally gold reacts very negatively to hikes in interest rates. Gold was not breaking down outside of this kind of choppiness. It got to this low end and then started to rally back. So for me, when I look at the price action in gold, gold is staying stable while you're seeing risk assets aside from crypto rallying substantially. I think the NASDAQ now is year to date up something like 38%. I mean, a massive, massive move. And so to me, this is a very bullish sign for gold. It's telling me that you have sellers that are moving out of gold to move into risk assets, but there's definitely buyers there, thus price is not falling.
Soloway also highlighted concerns in the commercial real estate sector, particularly in the office space, which has been greatly impacted by the shift to remote work. In the first quarter of this year, the delinquency rate for commercial real estate loans rose by 12 basis points to 0.77%, the highest it has been since the third quarter of 2021, when it reached 0.83%. This information comes from a recent report published by S&P Global Market Intelligence. Soloway emphasizes that this increase is more significant than it may initially appear. He further mentions the surging credit card debts, coupled with high unemployment rates and uncertainty surrounding the Fed's plans to raise interest rates. These factors contribute to a challenging economic landscape. Now, let's return to the video where Soloway delves into these details.
We hear that they've raised interest rates by X percent, which has been huge. I mean, the velocity of the raise, I think, is the shocking part. From going from a quarter basis point to where we are above 5% is just massive. But then you look at how much excess liquidity there was in the system because of COVID. And then you look at, all right, wages have increased substantially, so people have more money. I do think, like you're saying, there are cracks emerging, right? So last Monday when we did the no-shill zone, we talked about the jobless claims from the previous week being 266,000. And that was the biggest jump since 2021 in people filing for unemployment. And what I was saying is last week to really watch the next number, because sometimes you get these outliers, the data changes this calculation and it changes the numbers. But what we saw last week was 262,000 filing for unemployment, just 4,000 people difference. And to me, that's now saying, okay, it's probably not an outlier. You're beginning to see the effects of people getting laid off and filing for unemployment. So that would be one thing. A couple other things I'm seeing here. U.S. delinquency rates on credit cards are now rising at their fastest pace since 2008, right? So now it's not at the level, right? So the rate of change is rising, right? That's what it's equal to, but you're not at those levels. In fact, I'm going to show my screen here. This is a David Lynn, courtesy of David Lynn. And let me just throw mine in here. So here's his tweet. And I by the way, if you don't follow him, he's awesome at his data. He's a great interviewer and so forth. So definitely look to follow him. But U.S. delinquency rates on credit cards now rising at their fastest pace since 2008, although still nowhere near 2008 levels. So here you have the drive higher is essentially at that same rate, but you're still far below. So what that tells me is that people are still able to do their thing, even though the delinquencies are rising substantially. And then this one's kind of interesting as well, which says credit card debt now at all-time highs. And the reason why this is important in terms of credit card debt is because at all-time highs, if people stop paying their credit cards, it's a bigger deal to banks, right? So, if you don't pay your credit card and you owe $10 to the bank, okay. But if you own $1,000 and there's 1 million people that owe 1,000, now it becomes a bigger issue. And being at all-time highs is definitely unsustainable in the long run. The other thing too to just mention as I flip back to charts is that I also read that bankruptcies are now at their highest level since, I believe, 2011. Now, it's not at 2008, 2009 levels, but you're seeing again this shift. So for me, at least as an investor in stocks, in gold, in crypto, it's kind of the yellow light. You're not seeing the red flashing like, holy cow, we're going down with the ship, but you're seeing like, okay, there is a change going on here. And then the bigger question to bring back too is whether or not does inflation go back to 2% or under for the Fed, or do they get themselves in a pickle where we stick at 3% and it makes it very hard for them to bail us out whenever that big downturn comes?
The central bank has raised interest rates 10 times since last year, marking the most rapid tightening pace since the early 1980s. As a result, credit card rates have reached an all-time high. Despite the Federal Reserve hitting the pause button on its rate hiking campaign, the cumulative impact remains significant, according to Ted Rossman, a senior industry analyst at Bankrate. Since most credit cards have variable rates, they are directly influenced by the Fed's benchmark. As the federal funds rate increased, so did credit card rates. Currently, the average credit card carries a record high interest rate of 20.69%, nearly 5 percentage points higher than the beginning of the previous year, as reported by Rossmann. Although the recent pause in interest rate hikes may suggest rates won't rise this month, the persistently high credit card interest rates are unlikely to change anytime soon. As noted by Michelle Rennery, Vice President and Head of U.S. Research and Consulting at TransUnion, these sky-high APRs make credit cards one of the most expensive ways to borrow money on a month-to-month basis. Yet, many Americans continue to accumulate increasing amounts of debt, with nearly half of credit card holders carrying a balance from month to month, according to a bankruptcy report. Paying off high-cost variable-rate debt is an urgent priority for households, states Greg McBride, chief financial analyst at Bankrate. Soloway also shares his belief that the recent move by BlackRock could have a bullish effect on cryptocurrencies, particularly Bitcoin, as it sparked a rally shortly after the filing of ETF spots. Do you think the markets have become indifferent to the decisions made by the Fed? We would like to hear your thoughts in the comments section below. For more daily dose crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.